We see these money laundering scandals affecting banks really left and right here in Europe and especially in Scandinavia. How do you fix them?
Sure. The new CEO of Swedbank is a dear friend of mine and someone who's had a long history of cleaning up messes. I have enormous confidence in both in him as well as the Nordic banks to put themselves on a new trajectory. You know, the challenge is the industry spends over $100 billion a year in terms of AML, but our interdiction rate in getting it close to $2 trillion illicit flows, our interdiction rate is only 1%, and that's with 100% compliance. We need to rethink the way we do anti-money laundering specifically and the way in which we go after bad money generally.
Doesn't it raise the risk of increased regulation, increased scrutiny at a time when it's already an incredibly expensive job, needing a ton of manpower to be able to deal with compliance?
You know, as I said, we're at 100% compliance and we're still only getting 1% of the flows. It really is thinking a whole new paradigm. That means information sharing among and between institutions. It means information sharing with law enforcement and intelligence agencies. Very little of that happens now. Banks provide information to law enforcement authorities, but we get very little feedback in terms of what actually works and what doesn't. And then we need to be able to deploy the latest technology, machine learning, artificial intelligence. Machine learning is about pattern recognition. Many of this criminal behavior is really about pattern recognition. So we need to deploy the latest technologies, and we need to be free to do that.
I'm looking at a chart, Tim, of European bank stocks, and at the same time that we see the index, the broader stock market index at a high, in this case, the stock 600, we see European bank stocks index at a low. And this chart goes back to the early 90s. Why are European banks in such a poor state?
Sure. Well, the first reason is the interest rate environment is really challenging for them. Net interest margins is thin. The yield curve is really hurting them. We don't have banking union. We don't have capital market union. It is a highly fragmented European economy, and they're trying to compete with other institutions that have scale and much larger domestic capital markets. And they're all spending tremendous amount of money to deploy the latest technology and to implement Basel III and other regulatory changes in the aftermath of the financial crisis. There's a whole lot going on. There are some real industry leaders out there that are doing quite well, but by and large, we need capital market union, we need banking union, we need a different interest rate environment.
What about cost? You know, Mario Draghi says it's their own fault because they just haven't cut costs fast enough. Indeed, we see, you know, Deutsche Bank still has over 90,000 employees. HSBC has like 250,000 employees. Don't they need to reduce headcounts?
They need to reduce costs, and that's happening. Now, it's challenging in certain jurisdictions because of politics and local labor law. In certain countries, it's very hard to lay off or shed workers. It's very hard to shut down branches. And the regulators are slow to deploy and approve the latest technology. But cost is a part of the equation, and they need to do it more rapidly, and they need the help of the public sector. But we do need a different interest rate environment. That would be helpful, too.